Good morning and welcome back to Market Day Report. I'm Chris Swift. I've taken a look at the grain markets and they haven't done much of anything but go down since we reopened this morning. So let's take a look at them now. I got the March corn down 7 at 439 1/4, right on the low of the day. May down 6 1/4 at 449 1/2. That December contract down 4 at 472 1/4. And the soybeans, they are lower, down 14 3/4 on the March contract, 1194 1/2, quarter off the low of the day. May down 12 at 1204 1/4. And although you don't see the November contract up there, it was right at about 1177. So it's still lower as well. Take a look at Chicago wheat. It and Kansas City had been the lowest. March is down 9 3/4 at 590 1/2. The May down 10 at $6 3/4, and the July contract down 10 1/2 at 606, down 10 1/4. Kansas City hard red winter wheat down 14 1/2 on the March at 610 1/4, 607 1/4 the low tick. May 610 1/2, down 14 1/2, and July 609 down 14 1/4. And we'll wrap it up with Minneapolis spring wheat. March down 9 1/4 at 694 1/4, 691 1/4 the low. May down 7 3/4, 698 1/4. July down 8 at 705 even. And this is where I want to change hats and go from being a speaker here to a market analyst, because this would be my regular time on there. So I'll tell you something that's really kind of gotten me interested. 2 weeks ago when we were in Chicago, we got the idea that things were going to be softer in the first and second quarter. We saw quite a bit of analysts talk about the interest rates having impact on things, the improvement in moisture around the world helping things out there. And then lo and behold, we had this storm, and things had already started moving a little bit lower. They were softening, and then the storm came in. That storm seemed to have disrupted a lot of production and distribution more than production. And so that gave the grain markets just a little bit of a bounce. They stopped trading lower. And then as I went through 2/3 of Illinois this weekend, all of Missouri from east to west, and all of Kansas from east to west, there is ample moisture out there. And I believe that's one of our biggest factors of why we're seeing grains go back lower again this morning, is simply because of that factor that we are going to start out this year with tremendous subsoil moisture out there. So let's take a real quick look at our November beans real quick. I've got a chart of it. And on it, we see that we are trading now at right at 1175 1/2, down 9 1/2. These are new lows in this decline in the beans, both old crop and new crop. And even in the corn, although it's not quite new lows, if it were to close down at these levels, these would be a new low close. So we already dropped below that $12 level. Now we're trading 1175 1/2. And last week, I think our high was right around 1220. So the hard aspect of it is making sales in a down market. But I will say that from my analytics and from the moisture that I have seen out there, knowing that South America is going into a harvest, and it's going to be a big harvest regardless of how much they have knocked it down from its peak, it's going to be huge. I think you got to get busy and make some sales here, whether they be cash sales, whether they be hedges, whatever it is just is the atmosphere out there. The environment that we are trading in is negative. And that factor right there alone leads me to believe that if we were to lose $1 or $2 a bushel on beans, we may not be able to get that back again, even if we have some kind of spring rally. It might only put us back up to the levels of where we are right now. So as difficult as it may be, I would ask you to take just a few minutes sometime through the day, this evening, sit down and discuss what your marketing options are at this price level, and maybe have to make some very difficult decisions on marketing that grain, because I just don't see any kind of aspect. We might get something in the spring of the year where we see rallies that get some kind of planting intentions that could go wrong. But if nothing else really happens dramatically, it seems like we're on a downhill slide, both corn and beans and even wheat. And I got to walk through some wheat pastures on Saturday afternoon, and let me tell you, they were beautiful. And out there in Kansas, got to talk to a livestock producer out there, and clearly they had some damage, but it wasn't devastating. And I think that's the most interesting point, is we look at prices today and last week's rally kind of already starting to fade. So we're going to go away, take a real quick commercial break, and we're going to talk about those livestock when we get back. Stay with us. Welcome back to Market Day Report. Let's take a look at our livestock, and I kind of thought that we were softening this morning. February down 55 now at 177.90. The April contract down 30 at 181.37. June fats down 20 at 178.65. Our feeder market had lost a little bit of ground too, and it's not that bad, but March down 22 at 239.47. Again, remember that index, 232.06. April down 52 at 245.07, and the August contract down 32 at 265.27. Take a look at our hog market. It's still a little bit softer, but not too awful bad. Got Feb down 32 at 74.60. The April contract down 20 at 83.05. And the June hogs 95.72 down 27. So again, I'll talk about the feeder cattle market. In my opinion, these are enormous premiums to be looking at, not only via the feeder cattle index, but the historical high of the feeder cattle index, again, at 254.10. So when we divide our spring months versus our summer fall months out there, we clearly see the division. We clearly see the premiums stacked on there. And the reason for those premiums are clearly because we got fewer animals out there. But we know that. We have known that for a while, and there is an agenda in play that I think is causing this last little flurry higher to start to soften a little bit, and that is beef production and increased beef production going forward. It may sound a little bit ridiculous how we can do that with fewer cattle, but I can tell you that we can, and we are just not deficit that much just yet in beef production to be able to be in a situation where we're seeing just screaming high prices. So let's think about that for just a second. We had an anomaly to take place in the weather that created a very interesting impact onto cattle, but not for very long. I can tell you that the cattle where I was out there had already begun to straighten out again, and although there may be some instances where in regions we're impacted much more heavily, most of the snow is gone. They are going to deal with a lot of mud. We have no doubts about that, but that is not really a necessarily long-term loss of beef production out there. So I would urge you, if you're in a cattle feeder business looking at either from the aspect of a cattle feeder, looking to buy feeder cattle, or you're a backgrounder looking to market feeder cattle, those prices are very, very strong. And some of the option strategies that you can use can get you up marketing very close to that feeder cattle index, which today, or let me take that back, last week we saw that at that 254.10 price, or somewhere very close to that, produced a $309 loss per head on fat cattle last week. I'm going to wrap it up with this and know that we have really been very shallow on our volume of sales in both stockers and feeders for the last 2 weeks. That's going to have a big implication in May and June on our fat cattle market. So be careful out there. Make some tough marketing decisions, because I'll tell you, the market doesn't look like it's going to get any better anytime soon. And Tammy, I hate to be that way, because I know everybody kind of treads water, but I think it's pretty serious out there. We're going to improve, and we got spring coming. So as bad and gloomy as it may seem right now, it's going to get better.
Right, it certainly is.
Yep.
Thanks, Chris.